Very good afternoon from London. Welcome to the RANsquawk Weekly Wrap. Hope you've had a good trading day so far. Just going to run through one or two of the more interesting questions we've had sent through to the desk this week. Taking a look at where we currently stand then with the Italian sovereign rating. Moody's 90-day review of the country did expire yesterday, so we're expecting results from there anytime shortly or over the weekend. The current market talk is of a weekend downgrade by one notch to put them in line with the Fitch rating. However, many market analysts are expecting a double-notch downgrade, which would put them in line with the Standard & Poor's rating. And there's several reasons for this. Taking a look at the austerity measures, which was ratified into law this week after passing through the lower house. As they pass through the legislative process, there's been many amendments and changes to these austerity measures, and that has boded unfavourably in the eyes of the rating agencies. Also, we've seen some political infighting between particularly Berlusconi, the PM, who is very unpopular currently given his recent scandals, and the Italian Finance Minister Tremonti, who has borne the brunt of any political ire in regards to the austerity measures. Nevertheless, they have passed through, so that could be a plus point for the country. And in terms of their bond market, which is the third largest bond market in the world, so it has to be considered here, they've relied heavily recently on the ECB securities market programme to buy their debt in the secondary markets. And we've also seen various reports that Italy has been in contact with China and the Chinese Sovereign Wealth Fund to help potentially maybe invest in Italian blue chip stock, or maybe in fact take up some of the Italian debt through the Chinese Sovereign Wealth Fund. So it doesn't bode well for Italy in terms of the rating agencies there. Taking a look at the developments for Greece throughout the week then, it started off quite positively following the conference call between the German Chancellor Merkel, the French President Sarkozy and the Greek PM Papandreou, where the two Eurozone leaders, they reaffirmed their commitment to Greece and keeping it in the Eurozone, and the Greek PM reaffirmed Greece's conditions, or Greece's commitment to meet their bailout conditions. And we've also seen some strength come back into the euro on the back of that, and the general risk sentiment slightly coming back in with the Greek 10-year spread over bonds coming tighter onto the session today. That's also been allied with some Greek press reports in the Immerisia newspaper that in private sector participation in this second Greek bailout had reached the 82% level. That's excluding money market funds, so the level could have actually been higher as they reported, and that did also provide some risk sentiment, especially with the also reporting that the Greek finance minister had extended the deadline up until mid-October. And that's where we currently stood as we moved into today's session, and it has been a somewhat reversal of that. We have seen as the Finnish finance minister entered the ECOFIN meeting today, he said that the Greek collateral talks were still ongoing and he envisioned a deal to be done in mid-October. So that's a somewhat delay there. Also a warning from IMF's Lagarde overnight that the IMF may withhold aid or tranche fund aid in turn if Greece has not met bailout conditions. So another warning from IMF stock. There's also been some interesting reports from financial sources on one of the major news wires, citing that PSI rate is actually closer to 72%, so that did increase risk aversion on the back of that, somewhat contradicting the 82% earlier this week. We've also seen some interesting commentary from a statistics official who was recently been sacked from one of the Greek ministries, saying that he had to intentionally inflate or deflate figures so that Greece would definitely receive IMF and EU funds. So that's highlighting some perhaps corruption in Greece, and also another report from financial authorities saying that Greek banks may have to in fact tap the FSF, which is a fund stemming from the first Greek bailout, which may provide some emergency liquidity assistance to Greek banks to the tune of 10 billion euros. So the tide has turned slightly in Greece's not favour. So we have to see the results of this as we move throughout the weekend and come back in on Monday. So taking a look at the potential effects for this on Greece, it has to be seen with Greece currently staring into a recession for the next 2 years, where the Eurozone countries may in fact be willing to keep pumping more money into a Greek body which does not look like having any more signs of life. For the next 2 years we could see some fatigue there from the European citizens. So it does look eventually like that there will probably be some sort of Greek default, and whether or not it leaves the Eurozone is still to be seen. But that's enough from me today. As always, we love answering your questions here at RANsquawk. We very much appreciate our listeners, and we hope you have a great weekend and come back fresh on Monday for another great trading week.